I'm John A.G. Every fiat currency in history has eventually failed. The Collapse Files reveals how this happens. The patterns, the signals, the mathematics. Let's examine today's evidence. In 1930, global trade was at historic highs following a decade of expansion, technological innovation, and rising prosperity. Within 24 months, it had collapsed by 66%, the fastest sustained contraction in recorded history. The collapse didn't begin with a single catastrophic event. It began with a series of rational decisions by individual nations, each protecting their own interests, creating a cascade no one could stop once it started. Today, in late 2025, global trade volume growth has fallen to 0.8% annually, the weakest expansion outside of recession periods since World War II. Container shipping rates on major routes have fallen 70% from 2021 peaks. The Baltic Dry Index, which measures the cost of shipping raw materials globally, trades near 15-year lows despite persistent inflation in consumer goods. Export orders in major manufacturing economies are contracting at rates not seen since 2009. When the entire architecture of global commerce slows to near zero growth while debt, deficits, and currency creation accelerate, what does history suggest happens to the monetary systems that depend on trade to validate their currency values? For most of human history, trade was the mechanism through which money retained credibility. A currency's value was not determined by government decree or central bank policy. It was determined by what that currency could purchase and trade with other nations. This created a self-enforcing discipline on currency issuance and fiscal policy. The classical gold standard of the late 19th and early 20th centuries operated on this principle. Nations on the gold standard could not persistently run trade deficits without losing gold reserves. If Britain imported more than it exported, trading partners would demand gold for the difference. This gold outflow would reduce Britain's money supply, lower domestic prices, make British exports more competitive, and reverse the trade imbalance. The system self-corrected through the physical constraint of limited gold. This mechanism meant that international trade and sound money were inseparable. Trade imbalances were temporary and self-limiting. Currencies could not be debased indefinitely because trading partners would reject debased currency or demand gold instead. The volume of trade was constrained by the availability of sound money to facilitate it, but the money remained sound because trade enforced discipline. The Spanish Empire discovered the limits of this system through painful experience. Following the conquest of the Americas, Spanish silver flooded European and Asian markets in unprecedented quantities. From 1500 to 1800, approximately 150,000 metric tons of silver flowed from American mines to global trade networks. Spain believed this silver wealth would fund eternal dominance. But the influx of silver without corresponding increases in productive capacity created the Puritan price revolution, inflation of 300 to 400% across Europe over the 16th century. Spanish silver lost purchasing power. Spain itself suffered most acutely. The abundance of silver reduced incentives for domestic production. Spain became a conduit. Silver flowed in from America and immediately flowed out to pay for food, manufactured goods, and luxuries from more productive economies in Holland, France, and England. By the 17th century, Spain was effectively bankrupt despite controlling the world's largest silver mines. The kingdom defaulted on debts repeatedly. 1557, 1575, 1596, 1607, 1627, 1647. Each default was preceded by massive silver shipments arriving from America that should have prevented insolvency, but instead funded further borrowing and imports. The silver enriched Spain's trading partners while impoverishing Spain itself. The lesson was clear. Money abundance without productivity creates dependency on imports, which drains wealth, which requires more money creation, creating a spiral that ends in bankruptcy. Trade without balance is ultimately unsustainable, and money without discipline facilitates imbalances that destroy the currency's value. China understood this better than any empire. From the Ming Dynasty through the Qing Dynasty, China operated on a silver standard for nearly 500 years. Chinese merchants insisted on silver payment for exports, silk, porcelain, tea, because silver was the most trusted global store of value. European nations ran persistent trade deficits with China, paying in silver. This created a massive accumulation of metal in China, representing centuries of trade surpluses. By the 19th century, China held an estimated 20 to 30% of all above-ground silver in the world. This was not hoarding or mercantilism. It was the natural result of producing goods the world wanted while accepting only payment that held intrinsic value. The silver represented real wealth, goods exported, productivity demonstrated, value stored in physical form that no government could debase. Western powers sought to reverse these imbalances, not through superior manufacturing, but through opium exports, creating artificial demand for a product that drained Chinese silver reserves. The Opium Wars were fundamentally about trade balances and silver flows. When trade imbalances become large and persistent, The deficit nations resort to extraordinary measures to reverse them, often destroying the system that created the imbalance in the process. The critical insight from this period is that sustainable trade requires relatively balanced flows. Persistent surpluses accumulate wealth, persistent deficits deplete it. And when deficits are financed through currency creation rather than productivity improvement, the currency eventually loses credibility in international trade, forcing painful adjustment. The modern global trade system was designed deliberately in the aftermath of World War II to prevent the catastrophic collapse that occurred in the 1930s. The architects of Bretton Woods understood that the Smoot-Hawley Tariff Act of 1930 and the retaliatory trade restrictions that followed had turned a recession into a depression and contributed to conditions enabling the rise of fascism and global war. The solution was to create a system where trade interdependence was so deep that economic warfare would be mutually destructive and therefore irrational. The United States, holding the majority of global gold reserves and possessing the only major industrial base undamaged by war, agreed to open its markets to Allies' exports while maintaining dollar convertibility to gold at 35 per ounce. This created persistent U.S. trade deficits. The U.S. imported more than it exported. But those deficits served strategic purposes. They flooded the world with dollars needed for reconstruction and trade. They created economic dependencies that aligned with American geopolitical interests. And they allowed war-devastated economies to rebuild through export-led growth rather than autarky and protectionism. The system prioritized political stability and alliance cohesion over strict economic balance. For 2 decades, this worked remarkably well. European and Japanese economies rebuilt. Global trade expanded rapidly. The dollar became the unquestioned reserve currency. But by the late 1960s, structural contradictions were becoming unsustainable. U.S. trade deficits meant dollars were accumulating overseas faster than America's gold reserves could back them. The promise of dollar-gold convertibility at $35 per ounce was increasingly implausible. France, under Charles de Gaulle, began demanding gold for dollar holdings, viewing the arrangement as exorbitant privilege, allowing America to print currency and receive real goods in return. Other nations followed. U.S. gold reserves drained from over 20,000 metric tons in the 1950s to under 10,000 metric tons by 1971. The choice became binary: defend the gold peg by raising interest rates and accepting domestic recession, or abandon convertibility and allow currency values to float. In August 1971, President Nixon closed the gold window. The dollar was no longer convertible to gold. Exchange rates floated. The physical constraint linking currency issuance to trade balances was severed. This created the modern fiat currency system where trade imbalances are not self-correcting through gold flows or currency adjustments, but instead accumulate indefinitely, financed through debt and currency creation. The immediate effect was liberating for governments. Budget deficits could be financed through central bank money creation. Trade deficits could be sustained indefinitely as long as trading partners accepted payment in fiat currency. Interest rates could be manipulated to manage domestic economic conditions without regard to gold reserves or external balance. The constraints of the gold standard, which many economists had viewed as archaic and unnecessarily restrictive, were removed. But removing constraints also removed discipline. The United States ran larger and larger trade deficits, exceeding $800 billion annually by the mid-2000s. China, Japan, and Germany ran corresponding surpluses, accumulating trillions in dollar reserves. These imbalances, which would have been impossible under a gold standard, became the defining feature of global trade. The deficit nations consumed more than they produced, financing the gap through borrowing. The surplus nations produced more than they consumed, financing deficit nations' consumption. This arrangement was unstable but functional as long as both sides benefited. The U.S. got cheap manufactured goods that kept inflation low and living standards high despite wage stagnation. Surplus nations got industrialization, employment, and technology transfer. The dollar's reserve currency status allowed the U.S. to borrow at lower rates than economic fundamentals would otherwise justify. Export-led growth models created jobs for hundreds of millions in Asia and Europe. But by the 2010s, the bargain was fraying. The United States had lost significant manufacturing capacity. Factories closed, supply chains moved offshore, entire regions economically hollowed out. The political backlash was inevitable and manifested in demands for protectionism, tariffs, and bringing jobs home. China had accumulated over $3 trillion in foreign reserves and was developing technologies threatening U.S. dominance in strategic sectors. The trade imbalances that had been tolerated as beneficial were now viewed by both sides as exploitative or dangerous. The trade conflict that emerged was not primarily about balancing trade accounts. It was about technological supremacy, strategic decoupling, and preparation for potential conflict. The United States imposed tariffs on Chinese goods not to eliminate the trade deficit, but to slow China's technological advancement and force supply chain diversification away from Chinese dependence. China retaliated with tariffs, export restrictions on strategic materials, and development of alternative payment systems to reduce dollar reliance. By 2025, this has evolved into systemic fragmentation. The global economy is splitting into competing blocks with different technology standards, payment systems, and governance models. Companies face impossible choices about which markets to prioritize because operating in both simultaneously is becoming legally and technically difficult. Supply chains are being restructured at enormous cost, not for efficiency, but for security and political alignment. This restructuring is inherently contractionary for trade. When supply chains optimized over decades for cost efficiency are reorganized for political security, costs rise and volumes fall. When technology standards diverge between blocks, products must be manufactured in separate versions, reducing economies of scale. When payment systems fragment, transaction costs increase and trade finance becomes more complex and expensive. The consequence is visible in trade data. Global trade growth has slowed from 7% annually in the 1990 to 2008 period to under 3% in the 2010-2023 period to under 1% in 2024-2025. This is not a temporary cyclical downturn. It is a structural shift driven by deliberate policy choices to prioritize security and autonomy over efficiency and interdependence. The quantitative evidence of global trade deceleration is visible across multiple indicators that collectively show the system approaching stagnation. Global trade volume, the physical quantity of goods crossing borders, grew at an average annual rate of 7.1% from 1990 to 2008. This was the era of hyperglobalization when supply chains extended worldwide, manufacturing moved to lowest cost locations, and trade grew twice as fast as global GDP. The 2008 financial crisis disrupted this, but trade recovered and resumed growth. However, the recovery never restored previous growth rates. From 2012 to 2019, global trade volume grew at an average of 2.8% annually, less than half the pre-crisis rate. The COVID pandemic caused a sharp but temporary contraction in 2020. The 2021-2022 recovery was driven primarily by pent-up demand and inventory restocking. By 2023, growth had slowed to 1.7%. In 2024, it was 1.2%. Preliminary data for 2025 suggests growth below 1%, effectively stagnation. To contextualize, global GDP growth in 2024-2025 is approximately 2.5 to 3%. Historically, trade grew 1.5 to 2 times faster than GDP, the elasticity of trade to income. Currently, trade is growing at less than half the rate of GDP. This means that as the global economy expands modestly, an increasing share of that growth is in non-traded services and domestically consumed production. The traded goods sector, the foundation of the post-W economic order, is stagnating. Regional breakdowns show even sharper contractions in key corridors. US and China bilateral trade, which peaked at over $650 billion in 2018, declined to approximately $575 billion in 2023, a reduction of over 11%. But the composition is more important than the headline figure. High technology goods trade between the US and China, which accounted for 30% of bilateral trade in 2018, now represents less than 18%. Strategic decoupling is not eliminating trade, but is reorienting it away from advanced sectors. Intra-European trade, within the European Union, has grown at less than 1% annually since 2019, despite the EU's single market and common currency designed to facilitate trade. This reflects weak domestic demand, high energy costs following the Russia-Ukraine conflict, and competitiveness challenges versus Asian manufacturers. Asian interregional trade, which had been the fastest growing segment globally, has slowed from 8% annual growth in the 2000-2015 period to under 3% in 2023-2025. This reflects both slowing Chinese growth — China is the hub of Asian supply chains — and the restructuring of supply chains to reduce China exposure following trade conflicts and pandemic disruptions. Container shipping data provides a real-time measure of trade activity. The cost to ship a 40-foot container from Shanghai to Los Angeles peaked at over $20,000 in late 2021 during pandemic supply chain disruptions. By late 2025, it has fallen to approximately $1,500, a decline of over 90%. This collapse in shipping rates reflects weak demand for transport capacity, meaning fewer goods are being shipped. The Baltic Dry Index, which measures the cost of shipping raw materials like iron ore, coal, and grain, averaged around 2,000 points in the 2010-2019 period. It spiked to over 5,000 in 2021 during post-pandemic recovery. As of late 2025, it trades near 1 to 100, well below pre-pandemic averages and approaching multi-decade lows. This signals weak demand for raw materials used in manufacturing and construction globally. Export order indices from purchasing managers' surveys show contraction across major manufacturing economies. China's export orders index has been below 50, indicating contraction, for 18 of the past 24 months. Germany's export orders have contracted for 20 of 24 months. Japan shows similar weakness. South Korea, an export-dependent economy highly sensitive to global trade, has seen export volumes contract or stagnate for most of 2024-2025. Trade finance availability is tightening. Letters of credit, the instruments that facilitate most international trade by guaranteeing payment to exporters, have become more expensive and harder to obtain. The cost of trade finance has increased by an estimated 150 to 200 basis points since 2021, reflecting both higher interest rates globally and increased perceived risks in international transactions due to sanctions, payment system fragmentation, and counterparty concerns. Currency hedging costs have surged. Companies engaged in international trade must hedge currency risk to protect profit margins. The cost of currency hedging has increased substantially due to higher volatility and wider interest rate differentials between major economies. This makes cross-border trade more expensive and less attractive relative to domestic sales. Trade credit insurance, insurance protecting exporters against non-payment by foreign buyers, has become more expensive and more restrictive. Insurers have reduced coverage limits for emerging markets and even some developed markets due to concerns about recession risk, debt sustainability, and political instability. This makes exporters more cautious about extending credit to foreign buyers, reducing trade volumes. The composition of trade has shifted toward commodities and away from manufactured goods. Energy trade, oil, gas, coal, and food trade, grains, meat, have remained relatively robust because these are necessities with inelastic demand. But trade in manufactured goods, machinery, electronics, vehicles has stagnated or declined. This reflects weak investment demand globally and the shift towards services consumption in developed economies. Inventory to sales ratios globally have risen to elevated levels. Retailers and wholesalers are holding more inventory relative to sales than normal, indicating goods are not moving as quickly from production to consumption. This excess inventory reduces near-term orders to manufacturers and exporters, creating a feedback loop where weak demand reduces production, which reduces trade volumes, which weakens growth, which further reduces demand. Global container port throughput, the volume of containers processed through major ports, has stagnated. China's major ports, which handle approximately 30% of global container volume, reported flat to slightly negative growth in 2024-2025. Singapore, Rotterdam, and Los Angeles, other major hubs, show similar patterns. Stagnant port throughput directly reflects stagnant trade volumes. Air freight volumes, which typically carry high-value, time-sensitive goods, have declined by approximately 3 to 5% in 2024 to 2025 compared to pre-pandemic levels. This suggests weakness specifically in high-value manufactured goods trade, electronics, machinery components, luxury goods, which are the most profitable segments of trade. The data collectively paint a picture of a global trade system in structural slowdown approaching stagnation. This is not a temporary disruption awaiting recovery. It is the result of deliberate policy choices to fragment supply chains, impose tariffs and trade restrictions, and prioritize security over efficiency. And it is accelerating, not moderating. Growth rates are declining sequentially quarter by quarter. The near stagnation of global trade growth sends signals extending far beyond economics into the realm of monetary system stability and geopolitical order. The first signal is the invalidation of the core assumption underlying fiat currency systems, that economic growth and trade expansion can continue indefinitely, generating future tax revenues and export earnings to service ever-growing debt. Every major fiat currency system is built on perpetual growth assumptions. Government debt is considered sustainable if GDP grows faster than debt servicing costs. Trade deficits are considered manageable if export capacity can eventually expand to balance them. But if trade stagnates near zero growth, while debt continues expanding at 5 to 10% annually, the mathematics become unsustainable. Nations running trade deficits can no longer assume they will grow their way out through future export expansion. They must either reduce deficits through austerity, politically unacceptable, default on debts, economically catastrophic, or devalue currencies to inflate away debt in real terms, destroying purchasing power. Nations running trade surpluses face different but equally severe challenges. Export-led growth models that employed hundreds of millions in China, Germany, and Japan are failing as destination markets stagnate. Unemployment rises or workforces are underutilized. The social contracts in these societies, acceptance of low consumption and high savings in exchange for job security and rising living standards, are breaking down. Political instability follows. The second signal is the acceleration of currency fragmentation. The dollar's role as reserve currency and primary trade settlement currency has depended on the volume and depth of dollar-denominated trade. As global trade stagnates and as trade flows fragment into regional blocks, the necessity of holding dollars for trade settlement diminishes. China has been systematically developing bilateral trade settlement arrangements in yuan with major trading partners, Russia, Saudi Arabia, Brazil, and others. These arrangements bypass dollar settlement, reducing dollar demand. The volume of yuan-settled trade has grown from negligible in 2015 to over $500 billion annually in 2024. Still small relative to total trade, but growing rapidly. The BRICS nations, Brazil, Russia, India, China, South Africa, and new members, are actively exploring a common currency or settlement mechanism for intra-BRICS trade. While implementation faces substantial technical and political challenges, the mere fact of serious discussions indicates declining confidence in dollar-based settlement as the permanent global standard. European trade with Asia increasingly settles in euros rather than dollars, reducing dollars' role as intermediary. Japan and China have established yen-yuan swap lines allowing direct currency settlement. These developments are incremental, but directional, away from dollar dominance toward currency fragmentation. The consequence of currency fragmentation combined with trade stagnation is reduced liquidity in dollar markets. Fewer trade transactions requiring dollar settlement means less demand for dollars. Less demand means lower dollar values relative to real goods, inflation. And inflation in the reserve currency creates global instability, as every dollar-denominated debt becomes more expensive to service in real terms. The third signal is the breakdown of the exorbitant privilege arrangement that has sustained U.S. deficits for decades. The United States has been able to run persistent trade deficits because foreign central banks and private investors have been willing to hold dollars and dollar-denominated assets, or primarily U.S. Treasury bonds, as reserves. This creates a circular flow. The U.S. imports goods, pays with dollars, and foreigners recycle those dollars into treasuries, financing U.S. deficits. This arrangement requires that foreigners trust dollar assets will retain value and that trade volumes remain large enough to generate dollar accumulation. Both conditions are eroding. Trade volumes are stagnating and reducing dollar inflows to surplus nations. And trust in dollar stability is declining as U.S. debt reaches $36 trillion with no path to fiscal consolidation. Foreign dollar reserve holdings as a percentage of total reserves have declined from 71% in 2000 to 58% in 2024, the lowest in decades. If this trend continues, the U.S. will face difficulty financing deficits. Interest rates would need to rise significantly to attract foreign capital, increasing debt servicing costs and potentially triggering fiscal crisis, or the Federal Reserve would need to monetize deficits directly through money printing, risking inflation or hyperinflation. Neither option is sustainable. The fourth signal is the commoditization of trade toward necessities and away from discretionary goods. The resilience of energy and food trade compared to manufactured goods trade indicates that global demand is concentrating on essentials. This is characteristic of economies under stress. Consumption shifts from wants to needs. It also indicates that the wealth effect from asset appreciation, stocks, real estate, that drove discretionary consumption in developed economies is weakening. This shift has monetary implications. Energy and food are priced primarily in dollars. As trade concentrates in these commodities, dollar demand for settlement remains high, even as manufactured goods trade stagnates. But energy and food trade is far more politically sensitive than manufactured goods trade. Disruptions to food or energy supplies can trigger social unrest, political upheaval, or even conflict far more readily than disruptions to consumer electronics or clothing. This creates fragility. The dollar's role is increasingly concentrated in the most geopolitically sensitive trade sectors. Any disruption, sanctions, embargoes, conflicts that restricts energy or food trade immediately threatens dollar liquidity and stability in ways that manufactured goods trade disruptions would not. The fifth signal is the reemergence of barter and bilateral trade arrangements bypassing monetary settlement entirely. Russia, facing Western sanctions, has negotiated barter arrangements with India, China, and others, trading oil and gas for goods, machinery, or food, without currency intermediation. These arrangements are inefficient compared to monetary trade, but functional when currency settlement is restricted or distrusted. The growth of barter trade is historically associated with monetary system breakdown. When participants prefer physical goods exchange over currency settlement, it signals that currency is not serving its core function, acting as a trusted medium of exchange and store of value. This is an early stage signal of currency system failure. All of these signals point toward the same conclusion. The global trade system that has been the foundation of the post-WTO monetary order is contracting structurally. And as it contracts, the monetary arrangements dependent on it, dollar reserve status, perpetual deficit financing, currency stability, are becoming unsustainable. History provides clear precedent for what occurs when global trade contracts sharply while debt and currency creation continue expanding. The outcomes are not subtle adjustments, they are systemic breaks that reorder economic and political relationships. The 1930s collapse offers the most direct parallel. Global trade fell 66% between 1929 and 1933. This contraction did not result primarily from economic weakness, although the Depression contributed. It resulted from trade protectionism, the Smoot-Hawley tariff, and retaliatory measures that followed. Each nation acted to protect domestic industries by restricting imports. But when every nation restricts imports simultaneously, every nation's exports collapse. Total trade volume implodes. The monetary consequence was immediate and severe. Nations on the gold standard faced impossible choices: maintain gold convertibility and accept deflation and mass unemployment, or abandon gold and devalue currencies. Britain left gold in 1931. The United States effectively left in 1933 when gold was revalued from 20.67 to 35 per ounce, a 69% dollar devaluation overnight. France held on until 1936 before devaluing. Each devaluation improved that nation's export competitiveness, but only by making imports more expensive, importing inflation. The competitive devaluations of the 1930s did not restore trade. They intensified economic nationalism. Nations formed trading blocs: the British Commonwealth sterling bloc, the US dollar bloc, the German-led European barter bloc. Trade within blocs continued, but trade between blocs collapsed. The integrated global economy of the 1920s fragmented into isolated economic zones with limited interaction. This fragmentation contributed directly to World War II. Germany, isolated economically and unable to acquire resources through trade, pursued territorial expansion to secure raw materials and markets. Japan followed similar logic in Asia. The economic nationalism of the 1930s created conditions where military conquest appeared more feasible than peaceful trade as a means to prosperity. The post-WTO order was explicitly designed to prevent this recurrence. The Bretton Woods system, GATT, predecessor to WTO, and later trade agreements all aimed to make economic interdependence so deep that trade war and military war would be mutually destructive and therefore irrational. For 70 years, this largely succeeded. But now the architecture is fracturing. Current trade stagnation differs from the 1930s in pace but not in kind. The 1930s saw trade collapse 66% in 4 years, catastrophic and immediate. Current stagnation is gradual, growth falling from 7% to 1% over 15 years, but the trajectory is similar, from integration toward fragmentation, from cooperation toward competition, from multilateralism toward blocs. The monetary consequence will also parallel the 1930s, but potentially more severe because current debt levels are vastly higher. In 1930, U.S. federal debt was approximately 16% of GDP. Today, it exceeds 120%. Global debt was modest in 1930. Today, it exceeds $300 trillion, over 3 times global GDP. This debt was accumulated on assumptions of perpetual trade growth generating revenues to service it. If trade stagnates, debt becomes unsustainable. Governments face the same choices as the 1930s: austerity, cutting spending, raising taxes, default, admitting insolvency, or inflation, printing money to service debt in nominal terms while destroying its real value. The 1930s saw some defaults: Germany, several Latin American nations, and multiple competitive devaluations. The scale of current debt suggests the response will be predominantly inflation, not the moderate 2-4% central bank's target, but 8 to 15% persistent inflation that halves purchasing power over 5 to 8 years. For trade-dependent economies, Germany, Japan, South Korea, Taiwan, the consequences are acute. These nations built prosperity on export-led growth. If destination markets stagnate and trade protection rises, these economies face structural contraction. The social and political consequences include rising unemployment, fiscal stress as tax revenues decline and social spending rises, and political radicalization as populations lose faith in established institutions. For deficit nations, primarily the United States, the consequence is loss of the ability to finance consumption through trade deficits. Americans have maintained living standards above domestic production for decades by importing goods financed through dollar creation that foreigners accepted. If trade contracts and foreigners reduce dollar holdings, Americans must either consume less, accepting lower living standards, or face inflation as reduced imports create scarcity and higher prices. For commodity exporting nations dependent on global trade demand, contraction means reduced revenues and economic hardship. Brazil, Australia, Canada, and many African and Middle Eastern nations export raw materials to manufacturing economies. Stagnant manufacturing trade means reduced demand for commodities, lower prices, reduced export earnings, and currency depreciation. The geopolitical consequence is a return to bloc competition resembling the 1930s, but in modern form. A U.S.-led bloc, North America, allied European nations, parts of Asia, trading primarily internally. A China-led bloc, China, Russia, much of Central Asia, potentially parts of Africa and Latin America, doing the same. These blocs competing for resources, markets, and technological dominance. The competition need not turn military, though history suggests it might. But even economic competition at this scale will be disruptive and impoverishing relative to integrated global trade. The currency consequence is fragmentation toward regional or bloc-specific currencies. The dollar may retain dominance within the US-led bloc, but lose reserve status globally. The yuan may rise in the China-led bloc. Regional currencies, euro, possibly a BRICS currency, may emerge for specific trade zones. This fragmentation increases transaction costs, reduces efficiency, and makes international trade more complex and expensive, further reducing volumes in a negative feedback loop. For individuals, the practical consequence is reduced access to goods, higher prices, and economic uncertainty. The globalized economy of 2020 made an extraordinary range of goods available at low prices. Electronics from Asia, food from multiple continents, energy from global markets. As trade contracts and regionalizes, this abundance shrinks. Products become more expensive or unavailable. Supply chains become less reliable. The convenience and prosperity of globalization reverse. Wealth preservation becomes more difficult. In an integrated global economy, diversifying assets across borders provides protection. In a fragmented world with capital controls and currency restrictions, moving wealth across borders becomes harder or impossible. Physical assets, property, commodities, hard currency, become more valuable relative to financial assets that may be restricted, devalued, or defaulted upon. The historical lesson from every period of major trade contraction, the 1930s, the breakdown of the Western Roman Empire, the Ming Dynasty's turn inward, is that reduced trade correlates with reduced prosperity, increased conflict, and monetary instability. Trade creates wealth through specialization and comparative advantage. Reduced trade destroys that wealth. And in the scramble to preserve what remains, nations turn inward. Currencies lose credibility and systems break. In 1930, global trade was at an all-time high. 2 years later, it had collapsed by 2/3. The collapse was not caused by a single catastrophic event, but by a cascade of rational individual decisions that produced collective catastrophe. Each nation sought to protect itself through trade barriers. Together, they destroyed the system that had created prosperity for all. Today, global trade growth has decelerated to near zero, the slowest expansion outside recession since World War II. This is not a temporary cyclical phenomenon awaiting recovery. It is the result of deliberate policy choices, tariffs, sanctions, strategic decoupling, supply chain regionalization for security rather than efficiency. Each decision appears rational in isolation. Collectively, they are recreating the conditions of the 1930s. The difference is scale and speed. The 1930s collapse was rapid and visible, 66% decline in 4 years. The current deceleration is gradual, from 7% annual growth to 1% over 15 years. But gradual decline can be as destructive as rapid collapse. It simply unfolds slowly enough that each stage seems manageable until suddenly the cumulative effect becomes catastrophic. The monetary systems built on assumptions of perpetual trade growth are now confronting stagnation. Debt accumulated expecting future export revenues to service it. Currencies valued based on trade settlement demand. Geopolitical arrangements premised on economic interdependence making conflict irrational. All of these rest on trade continuing to grow. And trade has stopped growing. History offers no examples of major trade contractions that did not produce monetary instability, currency crises, defaults, or systemic breaks. The gold standard collapsed in the 1930s as nations chose devaluation over deflation. The Bretton Woods system collapsed in 1971 when U.S. trade deficits made gold convertibility unsustainable. Both collapses followed periods where trade growth assumptions embedded in the systems proved false. The current system, fiat currencies, floating exchange rates, massive debt, persistent imbalances, was built for a world of expanding trade. That world is ending. The system designed for expansion will not function in stagnation. It will not adjust gracefully. It will break, likely in ways that seem sudden despite years of warning signs. The warning signs are not subtle. They are visible in shipping rates down 90%, in Baltic Dry Index at multi-decade lows, in export orders contracting across major economies, in trade growth decelerating sequentially, in currency fragmentation and bilateral barter arrangements. The data is public, measurable, and accelerating toward breakdown. This is not a prediction of when the break occurs or its exact form. It is pattern recognition. Trade contractions of this magnitude have always produced monetary system failures. The mechanisms may differ: competitive devaluations, defaults, hyperinflation, currency replacement, but the outcome is consistent. The money systems dependent on trade lose credibility and are abandoned or restructured under crisis conditions. The freezing of global trade is not an economic data point to be managed with monetary policy adjustments. It is a systemic signal that the foundations supporting current monetary arrangements are eroding. And history shows that when foundations erode gradually, the visible collapse appears sudden, not because it was unpredictable, but because participants ignore the signals until denial becomes impossible. This is bad, not because trade data disappoints forecasts, but because trade stagnation invalidates the assumptions underlying the entire post-war economic and monetary order. And when core assumptions fail, systems built on them do not adapt smoothly. They break. The trade data says the break is approaching faster than anyone expected.